This is Terrence Andre Banks with Information Age Financial Solutions, coming to you an article from Yahoo Finance. Americans' middle class is addicted to a new kind of credit. This is an interesting article. I'm putting a link inside the description as usual. This comes from Bloomberg. They took an excerpt from there. Explore what's moving the global economy. New season of the Stefanomics podcast. The payday loan business was in decline. Regulators were circling storefronts where vanishing investors were abandoning the industry's biggest companies en masse. And yet today, just a few years later, many of the same subprime lenders that specialize in the debt are promoting an almost equally onerous type of credit. It's called the online installment loan, a form of debt with much longer maturities, but the same sort of crippling triple-digit interest rates. If payday loans target only the nation's poor, then the installment loan is geared to all those working-class Americans who have seen their wages stagnate and unpaid bills pile up in the years since the Great Recession. So essentially, this is affecting middle-class people here. In just a span of 5 years, online installment loans have gone from being a relatively niche offering to a red-hot industry. Non-prime borrowers now collectively owe about $50 billion on installment products, according to credit reporting firm TransUnion. In the process, they're helping transform the way that a large swath of the country accesses debt. They have done so without attracting the kind of public and regulatory backlash that hounded the payday loan. Installment loans are a cash cow for creditors, but a devastating cost to borrowers, said Margaret Saunders, Senior Counsel for the National Consumer Law Center, a nonprofit advocacy group. Here's the subprime evolution. For many families struggling with rising costs and stagnant wages, it's a cost they're increasingly willing to bear. In the decade through 2018, average household incomes for those with a high school diploma has risen about 15% to roughly $46,000, according to the largest U.S. Census Bureau data available. Not only is that less than 20% increase registered on a broad basket of goods over the span, but key costs that play out in the outsized role in middle-class budgets increase much more. Home prices are up 26%, medical care 33%, and college costs are a whopping 45%. To keep up, Americans borrowed a lot. Unsecured personal loans as well as mortgage, auto, credit card, and student debt has all steadily climbed over the span. For any payday lenders starting in encroaching regulatory restrictions and accusations of predatory lending, the working class growing need for credit was an opportunity to reinvent themselves. They saw the writing on the wall and figured, let's anticipate this and figure out how to stay in business. University of Pennsylvania professor specializing in urban poverty and author of The Unbanking of America, How the New Middle Class Survives. Triple-digit rates enter the online installment loan, aimed in the past at a fast-expanding group of near-prime borrowers, those with bad but not terrible credit, with limited access to traditional banking options. Ranking anywhere from 100 to 10,000 or more, they quickly became so popular that many alternative credit providers soon began generating the bulk of their revenue from installment rather than payday loans. Yet the shift came with a major consequence for borrowers. By changing how customers repaid their debts, subprime lenders were able to partly circumvent growing regulatory efforts intended to prevent families from falling into deep debt traps built on exorbitant fees and endless renewals. Whereas payday loans are typically paid back in one lump sum in a matter of weeks, terms on installment loans can range anywhere from 4 to 60 months, ostensibly allowing borrowers to take on large amounts of personal debt. In states such as California and Virginia, interest rate caps enacted years ago are meant to protect payday borrowers only applied to loans below $2,500. For a subprime lender, Nova International Incorporated, outstanding installment loans averaged $2,123 in the second quarter versus $420 for short-term products, according to recent regulatory filing. Larger loans have allowed many installment lenders to charge interest rates well in the triple digits. In many states, Invo's net credit platforms offers an annual percentage rates between 34 and 155%. In fact, Virginia sued Net Credit last year for avoiding state interest rates caps, while California government gave news in early this month signed to a law measure capping interest rates between $2,500 and $10,000 at 36%, plus the Federal Reserve's benchmark currently around 2%. The story continues. A representative for Evo directed Bloomberg to firm latest quarter finds where the company says the Virginia claims are without merit. He's right. I mean, if you need the loan, you need the loan. This is the benefit of installment loans is you have more time to make the payments. The downside of the payments of these high-cost loans go exclusively toward the interest, possibly up for the first 18 months. The National Consumer Law Center Saunders said. This industry, for its part, argues that just as with payday loans, higher interest rates are needed to counter the fact that non-prime consumers are more likely to default. between Enroll and Rival Online Lender, Elevate Credit Incorporated. Write-offs for installment loans for the first half of the year averaged about 12% of the total outstanding, well above the 3% of the credit card industry. See, they're making a point here and they're proving their argument. With high cost credit, you're only serving people that won't qualify for other types of credit. So you're already in a hardship situation, said John Hector, and analysts at Jefferies LLC. Companies have to price for that. According to Elevate most recently quarter financials, net charge-offs for their Rise installment loan product equaled about 45% of the revenue these loans generated. By the time they get to be our customers, they may have hit that speed bump at least once. Often they will have run into medical bills or job loss, which knocks out their ability to get other forms of credit, said Jonathan Walker, who heads Elevate Center of the Middle Middle Class, a research and data gathering unit that analyzes the borrower's habits of more than 150 million Americans without prime credit scores. Elevate's average online subprime installment loan customer has an annual income of about $52,000. Let's see this again. The average online subprime installment loan customer has an average about $52,000. About 80% has been to college and 30% own a home, according to Walker. More than 10% of the company's core customer base makes over $100,000 a year. 10 years ago was payday loans or nothing, and today there's been a lot of innovation to meet the consumer where they are, Walker said. The surprising popularity of online installment loans, combined with growing ability to tap into big data to better screen customers, help boost the fortunes of many subprime lenders. Trump administration's decision earlier this year to delay and potentially weaken planned restrictions on payday lending that were announced in 2016 has also bolstered the industry's outlook. Elevate's annual revenue rose about 1,000% in 5 years through December to $787 million, while Avova has grown for 46% in the span of $1.1 billion, according to data compiled by Bloomberg. Some prime installment loans are now being bundled to securities. Whoa! Not only are they getting this, they're bundling them to securities for sale to bond investors, providing insurers an even low cost of capital expand investor base. Net credit loans. The deal paid buyers yield between 4% and 7.75%. Its debut asset-backed security issued a year ago contained loans with annual interest rates as high as 100%. The bulk of their growth has been fueled by the middle class. About 45% of online installment borrowers in 2018 reported annual income over $40,000, according from the Experian PLC and Clarity based on study sample. When I first started, I'm kind of skipping a little bit. Personal bank result, Mo Pool, Messenger, Character, and Austin and William Delaware. Middle Americans' growing dependency on credit has fueled a market shift in types of clients who come through her door. When I first started, most filings were from the lower class, but now I have people who are middle class and upper middle class, and the debts are getting larger, said Poole, who's been practicing law for 2 decades. Generally, the debtors have more than one of these loans listed as creditors. This is crazy. If the economy was so good, you would not have this many people borrowing in this kind of rate. And these new installment loans, if you're not familiar with them, it's the new things. It's the new payday loans, it's the installment loans. Encourage you to take a look at this article. Prepare for the times that we're living in. If this video has been any value to you, please subscribe, leave some comments. And to my next video, I'm out.